Hey guys, Ben here. In this video, I'm going to be discussing a potential 10x opportunity. This is a disruptive company in the healthcare industry. It has high growth, high margins, and it's just gone public via a SPAC merger. Now, for those who don't know what a SPAC is, it basically stands for a special purpose acquisition company. It's basically just a shortcut for companies to go to the public markets. Consider it like the new IPO. Now, there's been so many SPACs recently, and on this channel, I try to only cover the most high quality SPACs I can find. One of them being some investors into the company include the legendary Peter Thiel, who was the co-founder of PayPal along with Elon Musk. He is now the CEO of Palantir, and he was also one of the original investors in Facebook. His founders fund has invested into this company. But that's not all. Surprisingly, I discovered that a value investor named Howard Marks, he's a legendary investor. I've spoken about him many times on this channel before. He's invested into this company with his investment firm, Oaktree Capital. Now, I've not seen anybody else talking about this, and I only noticed because I noticed the logo for the SPAC company was the same as the investment firm. So if you guys appreciate updates like this, feel free to give this video a big thumbs up. So in this video, I'm going to deep dive into the company. I'm going to do a full valuation, and I'm even going to dive into the technical charts for you guys and give you guys my price target. Before we dive into that, if you're new around here, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. If you wish to take things one step further, feel free to hit that first link in the description below to find out more about the VIP membership group. There you can gain access to my buy and sell signals, so you'll know exactly when I buy stocks and exactly when I sell stocks. In addition, you can access my entire investment portfolio. So if you're interested in joining or you're just curious, feel free to check out that first link in the description below, and you'll get early updates when I find new stocks to invest into. And with that being said, let's dive in. So what's this company? Well, this company is called Hims & Hers, and it's a digital pharmacy. Now, I just love that phrase straight off the bat, digital pharmacy. Traditional pharmacies, these brick and mortar retailers, they're so old fashioned. A digital pharmacy is the way forward for the future, and that's pretty clear to see. Now, this is a disruptive company in the healthcare industry targeted at millennials. So diving into this headline here, Hims & Hers announces a 91% year-over-year growth ahead of its SPAC merger. The company also announced $44.13 million in revenue in Q3. So the company announced a merger agreement with Oaktree Capital Management sponsored special purpose acquisition company, Oaktree Acquisition. Now, Oaktree Capital is the investment firm of the great Howard Marks. Now, to put how legendary Howard Marks is into perspective, Warren Buffett reads Howard Marks' memos and he finds them extremely valuable. So this guy truly is one of the greats. Hims & Hers is a digital pharmacy which combines two fast-growing industries, one of them being telemedicine, which is growing at a compound annual growth rate of 15% per year, and it's been growing at that rate between 2016, and that's predicted to continue up until 2027. And it combines this with mail-order wellness products. Now, the company started with mail-order sexual health products for both Hims and Hers. Now, a short-term catalyst for the stock is that the company landed FDA authorization for a mail-order self-collected saliva sample kit for testing for the global Rona. Now, the company is targeted at millennials, but it also plans to grow with their customers' needs. So as their customers get older, they'll need more expensive healthcare, and this company will benefit. So diving into their investor presentation now, let's take a look at the company at a glance. So they only have 131 employees, so this is a really small company still. They have over 71% gross margins, which is extremely high. Over 250,000 customer subscriptions. Yes, this is a subscription service, and those are known for recurring revenue, high margins, and are extremely profitable. So 91% of this company's revenue comes from recurring revenue, and this makes complete sense. If you purchase one of their medical products or one of their wellness products, let's say one for hair loss, you're going to need that every single month. So you don't just buy it once, you're going to need it every month. And this is what that company is counting on for revenue. As you can see here, the revenue has grown exponentially. So we had 128% CAGR between 2018 and 2020. Bear in mind, smaller companies can grow faster than larger companies, but still 128%, that is incredible. Generally, I say a growth stock is one which is growing at least 20% per year. 128% over the past 3 years is incredible. Now, the reason for this is the US healthcare system is the last major market to be disrupted. So the healthcare market is worth over $4 trillion. Trillion. Now, if you guys know the US healthcare system well, you'll know that the system is broken and it can be extremely expensive for everyday citizens to get proper healthcare. And according to this data here, 50% of their US families can't afford. A third of US families decided not to seek medical care in the past 12 months due to the cost. 3 out of 4 millennials would rather search for medical advice online versus seeing doctors in person. And this is especially true if somebody has an embarrassing issue. They're going to want to do this online, over the phone, rather than having to go in and see somebody face to face. This is the new generation. But even once you pay the ridiculous cost and you do manage to get an appointment, you can be waiting for a very long time and it can be extremely inconvenient.
Make the appointment for 11. This does not happen at the salon.
Oh yeah, that's because Jorge is cutting your hair, not playing God.
And the thing with this company, I have always thought this, why does healthcare have to be so unstylish and boring? Let's make a stylish healthcare company. And this is what this company's got right here. If you want to buy their products and services, it's modern, it's nice, it's like buying cosmetics. So here's some of the company's major issues that they're addressing. And often many of these issues can be quite embarrassing for many people. So the first is hair loss. That's a over $3 billion market size. Now the next section is ED. And you can see that market is over $4 billion. And the next section is anxiety and depression. We know that is affecting a massive amount of people right now. And nobody is talking about it, let alone trying to solve it. And then, of course, you have dermatology or skincare, which is a $44 billion market size. Hims and Hers is hitting each one of these markets and trying to disrupt them. So I spoke about another telehealth company in the past called Teladoc, which recently did a merger with Livongo. Full disclosure, guys, I do own shares in Teladoc. And this is a leader in telemedicine. But with Hims and Hers, they're not trying to compete directly with Teladoc. Teladoc is a true giant. They're really trying to disrupt and create their own niche market. And this is what Peter Thiel used to say, don't compete with other people, create your own market. And maybe that's why he invested into these guys. So diving into the revenue by product, you can see most of these companies' products are in the sexual health space, which is a massive market for millennials. So over 50% of their revenue is in that industry. Then we have hair and dermatology 35% and wholesale 7%. So this company really is attacking a niche market. The company's margins are exceptional. So they've grew their margins from 29% in 2018 to 71% in 2020. And that's expected to grow to 75% by 2022. Now, the adjusted EBITDA is negative, so you've got $68 million loss there, $66 million, but that has been reducing over time, which is what we like to see. So just $20 million of losses there, and that is predicted to decrease even more to $9 million of losses by 2022. So this company does seem exceptional. It's in a disruptive market, it's backed by some fantastic investors, it has high growth, high margins, and a lot going for it. So what are the issues? Well, usually it does come down to valuation. So let's dive into the transaction details right now. So the acquisition company is called Oaktree Acquisition Corp, ticker symbol OAC. If you invest into the acquisition company, you're only entitled to 12% of the final company. Now, this confuses many people, and many of you guys will comment below and say, what does that actually mean? And it may be quite confusing for some of you because it's quite complicated. But if I explain it simply, it basically has to be taken into account when you do a valuation model. Now, I'm going to do a valuation for you guys so you won't have to worry about it. So basically what I've done is equated that 12% with the current market cap. So the current market cap of the company, we're at around $17 per share. I did try to get this video out as early as possible for you guys. Apologies for that. These SPACs do run up fast. Market cap, $825 million. And by doing the valuations, which I won't bore you with, that's a 12.5 price to sales, which is quite conservative. Now, this is up from a price to sales of 8.9. So at the current price of sales, you're basically paying 12 times the company's sales. Is this a good valuation? Is this a bad valuation? Well, let's dive into some of the competitors. Now, the good news for this company individually is the entire industry is expensive. So this company actually looks quite cheap. It says 8.9 there. We know it's 12 now. Livongo had a 29 price to sales. Teladoc 15. One Medical 9. GoodArt 32. So the peer group average is 21. So this does say the company is undervalued. One of the major differences being these companies here are real giants and they're still growing immensely fast. Livongo and Teladoc have actually joined together, although they don't attack this niche, which these guys do address. Let's dive into the technicals right now. We'll take a look at the charts. So don't let this confuse you guys. if you're not used to looking at charts. I'll just explain it really briefly here. So we've got a candlestick chart here. Each of these candlesticks represent a day of trading. And as you can see here, there's been a lot of bullish momentum on the stock, and the stock has obviously gone very high due to the exuberance behind it. However, it's above the moving average. So the moving average is this blue line here, and that means it's overextended at the moment. So we could expect a pullback. That's the way the technical charts work, but it's not an exact science. This could be skewed. If it does pull back, where would I expect it pull back to? Well, I've got the Fibonacci retracement up here, and these have got the different potential places where it could pull back. First, I can see it as potentially around $14 per share. This is a strong one at $11 per share, which is basically on the moving average. If it did drop to that level, I would definitely load up the truck on this stock. In the short term, I would personally say anything below around $20 per share is still good value considering the growth in this company and the backing behind this company. But if you are investing into it at this stage and it's ran up by 75% and it's overextended from the moving average, then do expect a potential pullback. So this stock might pull back down to $11 per share, and then you might lose 50% in the short term. For me personally, this would be a long-term investment. I wouldn't be holding it for just a short period of time. So that's the company. It does have the potential to 10x. My personal price target, anything below $20. Anything above that, there could be some issues. And also do expect a potential pullback in the near term. For me, this would be a long-term investment. So if you guys found some value in this video, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. If you're new around here and you still haven't subscribed, what are you waiting for? Go ahead, hit that subscribe button, join the investing family, and turn that notification bell on. If you wish to take things one step further, hit that first link in the description below to be taken to the Patreon page where you can check out the VIP membership group. There you can gain access to exactly when I'm buying and when I'm selling stocks, in addition to my entire six-figure portfolio. The stocks and the stories, if I grew that portfolio from just $20,000 to over $200,000. So if that's something you're interested in and you would like to join, or you're just curious, feel free to hit that first link in the description below, and I'll see you guys on the other side. And with that being said, I hope you guys have a tremendous day, and I'll see you in my next video. Invest safe.